What is up, YouTube? What is up? We are back with another lesson today. And first off, I just want to say, hope everyone is having an amazing day so far. And what I want to talk about today is a price retracement tool, also known as Fibonacci. Okay, so what I use the Fibonacci for, right? um, is just a range um, in an area, right? So I can either um, sell at a premium or buy at discount, right? So in placing fibs when we're in a bearish um, scenario or when we're looking for a bearish setup, right? We want to place your fibs from the highest point or the recent swing high to the most recent swing low. And then vice versa, when we're looking for a bullish scenario, right? We'll take our Fibonacci from the lowest point of the swing low to the highest point of the swing low. So we can go and show you some examples here on how to place Fibonacci, right? So let's just start here. We see this aggressive impulse up, right? So this would be the low of this swing high up to this area, um, to the highest point of the swing, right? So place our fibs at the top there, and notice that price will retrace back into that area, right? And then have a nice reaction. So this is your simple bullish scenario. We have this last down candle, which I'm sure on a smaller time frame, you can definitely refine your entry and find a even tighter entry, right? Um, that is for another video though. Um, so even look right here. So from see how we have this swing or this low right here to this high right here, right? So we would take our fibs from this low point, from this swing low, up to this swing high about right here. So we'll place the fib at the top there, and then you see how price comes cleanly back down into the 72 fib area, right? And then price goes up and just taps that negative 10, uh, negative 0.10 take profit area. So that is a bullish example. Here is a bearish example, which actually I had taken this trade and it was a very nice trade. So we have this last up candle, right, before this aggressive move down. Okay, so structure had been broken from this right here. So what I did, right, we looked for that outcome candle and gauge that area first, right? and then we take our fibs from this swing high to this swing low. So the most recent swing high to the most recent swing low. Okay. So as you can see, price rejected from this 88 and 95 fib level very, very cleanly, right? From this area, about 70 pips, 72 pips max on that trade, which was very beautiful. Um, so here we can look at some recent examples that I have actually taken using this price retracement tool. So what we see is Euro GBP on the hourly time frame, and we had this spike up and then this aggressive move to the downside, right? So this last up candle before this aggressive down move and structure to the left had just been barely tapped, right? This low right here, we had gotten a new low that was broken. So in this area right here, right, the open is right here of this candle. So that's why this gray box is sitting here in the first place. So um, I want to make one thing clear, right? Uh, we don't use the fib, we don't use the Fibonacci as an entry tool, right? Um, because your point of interest um, is going to be any other. The reason why price rejects from any of these levels is any other catalyst in price action um, not not a fib level, right? Um, but what I use it for is just a better gauge um, of when a price uh, retracement, might occur, like when that rejection might occur from this price retracement, right? So we were looking in this area in between the 78 and the 72 fib level on Euro GBP, and you can see beautifully, right? We had a nice rejection. This was over 50 plus pips, came down and just barely, beautifully tapped that negative 20 take profit, that negative 10 take profit area right under these lows. Now, another recent setup that I have taken is on the 4 hour on Euro NOK, which would be the Norwegian krone, right? So we have this last up candle before this aggressive move down. We had structure that had been breached, right? It had been broken. So we had a new low that was created. So from this swing high to this swing low was where the fibs needed to be placed, right? So um, as you see, price retraced back up beautifully into this area, and we got a beautiful rejection from this area here for about 200 pips, 200 plus pips. And I think this was like 2 days. Yeah, two or 3 days. So very, very, very useful tool. that you can use just to gauge price, right? So what are some key notes that you can take away from this? What are some key notes? So first off, take off, if you are going to use this price retracement tool, this Fibonacci tool, take off the 61.8 fib, right? As you know, most retail traders use the 61.8 Fibonacci. Um, they call it, what do they say? It's their so-called golden pocket area, right? Don't don't have the same ideas as retail traders, okay? Because what tends to happen sometimes, and I've seen it quite a bit, is price will reject from that 61.8 level and then spike up or spike down, whichever scenario you're in, whichever market you're in, and will um, retrace to a higher supply level or retrace to a lower demand level, right? So if you understand supply and demand, you should also understand that the banks want to sell at higher um, price levels and they want to buy at lower price levels than retail, right? So here's a good way of looking at this. So when you go shopping, we'll look at it from a buying perspective, right? When you go shopping, you want to let's say you go to the store, okay, the grocery store, and you want to buy groceries on clearance, right? On sale. You want to buy, at the best deal you can buy at. So why would we buy with 95% of other traders when we can simply have the patience for price to get to a lower discounted area, you know, a lower discounted area before we, start buying in these areas, and vice versa. Say you buy something in the past and you want to, excuse me, you want to sell it, right? You want to sell it to somebody. Well, if you're selling to someone, at this price, but then somebody offers you a higher price to sell it from, right? Who would you sell your product to? The person that's willing to you know uh buy, you should say, or rather sell at a higher price point. That way you will be making more of a profit. If you sold down here, versus if you sold up here, there's this whole um, gap of price that you could have made, just a little bit more money just by simply waiting for price to get to a higher um, premium area. So more key notes that you can take from this is, um, also consider wicks as a high or a low point, right? So just as we mentioned in the beginning of the video, um, sometimes your point of interest will just have a body. Other times your point of interest will have a wick, um, maybe wicks in that area. Use that too, because at one point this wick was a high. At one point, this wick was a low. Okay, so consider the wicks as a high or a low point as well. Um, Now I want to make this clear again. Fibs are not a entry tool, right? It is a price retracement tool towards our outcome candle. It is a price retracement tool towards your point of interest, right? Any other catalyst in the market of why price rejects from a certain area, the last catalyst that it's going to be is because of a price retracement tool. It's not because of a Fibonacci for the reason why price rejected from where it did. So with that being said, um, this is why retail loses and doesn't understand the actual concept of a price retracement tool, because when price retraces into that 61.8, or as they say, that golden pocket area, they don't look for any other catalyst other than that. They're either buying or they're selling in that 61.8 area just because it got to that 61.8 area. So I want to make that clear to not do that, right? It's not an entry tool. It is a price retracement tool towards your point of interest, your actual point of interest, okay? So another keynote you can take is take profit levels. Um, I use the -10 fib level and the -20 fib level, and those are just good parameters, right, for take profit zones. Most of the time they're around 50 plus pip areas. So as you just saw in the previous examples that I showed, um, both uh, you know both trades had traded down or eventually traded down into that -10 area. So that's a good target area. And last but certainly not least, and maybe even the most important, is your engulfed outcome candles or your engulfed point of interest, right? That should be your main focus, okay? So don't just go and be placing fibs on every high, or excuse me, every low and every high, or every high and every low, all right? It doesn't work like that. So if there's no outcome candle, there is no trade, right? If you don't have a solid point of interest of why you're putting a Fibonacci um, at a swing high to a swing low, or at a swing low to a swing high, then there is no trade. There is no trade, okay? So yeah, that is pretty much all I wanted to talk about with this price retracement tool. It's really not a hard concept to grasp, right? Maybe just a weekend or so of back testing how to properly place fibs, and how properly finding your point of interest in premium levels and discount levels, right? So yeah, if you guys enjoyed this video, give me a like, give me a subscribe, and also comment down below. Let me know what you learned, maybe some key notes, maybe um, gave you some insight. Maybe you used Fibonacci before you watched this video, and this might help you out in a different way. If you are a person that buys and sells at the 61.8 0.8 level. Um, if you are that person, maybe go back and back test this again and see how many times there's manipulation around this 61.8 area. Okay. So, but yeah, that was it for this video. Hope you guys continue to have an amazing day. Let's keep killing these markets. And until then, peace out.